5 self-employed retirement plans to consider. Traditional or Roth IRA, best for those just starting out. If you're leaving a job to start a business, you can also roll your old 401k into an IRA. IRA contribution limit is $7,000 in 2024 or $8,000 if you're age 50 or older. The tax advantage here is a possible tax deduction on contributions to a traditional IRA. There's no immediate deduction for a Roth IRA, but withdrawals in retirement are tax-free. These are individual plans, meaning there is no employee element. If you have employees, they can set up and contribute to their own IRAs. One note, the Roth IRA has income limits for eligibility. Those who earn too much can't contribute. If you found this information helpful, don't forget to like and subscribe for more financial tips. Solo 401k. Best for a business owner or self-employed person with no employees, except a spouse, if applicable. The contribution limit for 2024 is $69,000, plus a $7,500 catch-up contribution, or 100% of earned income, whichever is less. To help understand the contribution limits here, it helps to pretend you're two people, an employer of yourself and an employee of yourself. In your capacity as the employee, you can contribute as you would to a standard employer-offered 401k, with salary deferrals in 2024 of up to 100% of your compensation, or $23,000, plus that $7,500 catch-up contribution, if eligible, whichever is less. Employee contributions must be made by December 31st. In your capacity as the employer, you can make an additional contribution of up to 25% of compensation. Employer contributions must be made by the tax filing deadline or extension date if applicable. There is a special rule for sole proprietors and single-member LLCs. You can contribute 25% of net self-employment income, which is your net profit less half your self-employment tax and the plan contributions you made for yourself. The limit on compensation that can be used to factor your contribution is $345,000 in 2024. The tax advantage of this plan works just like a standard employer-offered 401k. You make contributions pre-tax, and distributions after age 59.5 are taxed. You can't contribute to a solo 401k if you have employees, but you can hire your spouse so they can also contribute to the plan. Your spouse can contribute up to the standard employee 401k contribution limit, plus you can add in the employer contributions for up to a total of $69,000 in 2024, plus a catch-up contribution if eligible. This potentially doubles what you can save as a couple. How to get started. You can open a solo 401k at many online brokers. You'll need to file paperwork with the IRS each year once you have more than $250,000 in your account. SEP IRA. This plan is best for self-employed people or small business owners with no or few employees. The contribution limit is the lesser of $69,000 in 2024, or up to 25% of compensation or net self-employment earnings, with a $345,000 limit on compensation that can be used to factor the contribution. Again, net self-employment income is net profit less half of your self-employment taxes paid and your SEP contribution. There is no catch-up contribution. Be sure to make your contributions by the federal income tax filing deadline, usually mid-April, or the extension deadline if filing for an extension. The tax advantage is that you can deduct the lesser of your contributions, or 25% of net self-employment earnings or compensation, limited to that $345,000 cap per employee in 2024, on your tax return. Distributions in retirement are taxed as income. Previously, there was no Roth version of a SEP IRA. Under legislation signed by President Biden in December 2022, Roth contributions are now allowed. Employers must contribute an equal percentage of salary for each eligible employee, and you are counted as an employee. That means if you contribute 10% of your compensation for yourself, you must contribute 10% of each eligible employee's compensation. You can open a CP IRA at many online brokers just as you would a traditional or Roth IRA, with a few extra pieces of paperwork. Simple IRA. This plan is best for larger businesses with up to 100 employees. The contribution limit is up to $16,000 in 2024, plus a catch-up contribution of $3,500 if you're 50 or older. If you also contribute to an employer plan, the total of all contributions can't exceed $23,000 in 2024. Contributions must also be made by tax day or the extension deadline if applicable. The tax advantage is that contributions to a traditional simple IRA are deductible, but distributions in retirement are taxed. Contributions made to employee accounts are deductible as a business expense. Secure 2.0, signed into law in 2022, allows for Roth contributions. Unlike the SEP IRA, the contribution burden isn't solely on you. Employees can contribute through salary deferral, but employers are generally required to make either matching contributions to employee accounts of up to 3% of employee compensation, or fixed contributions of 2% to every eligible employee. Choosing the latter means the employee does not have to contribute to earn your contribution. The compensation limit for factoring contributions is $345,000 in 2024. The process is similar to a SEP IRA. You can open a simple at an online broker with a heavier paperwork load than your standard IRA. Defined benefit plan. This plan is best for a self-employed person with no employees who has a high income and wants to save a lot for retirement on an ongoing basis. The contribution limit is calculated based on the benefit you'll receive at retirement, your age, and expected investment returns. The tax advantage is that contributions are generally tax deductible, and distributions in retirement are taxed as income. An actuary must figure your deduction limit, which adds an administrative layer. If you have employees, you generally offer this plan to them and make contributions on their behalf. Your options for brokerages are more limited than with the above accounts. But Charles Schwab offers defined benefit plans. Make the background music informative.